Hello, my name is Corey Wells with USMR Market Insights and US Money Reserve. Today we're going to talk about the Fed rate hikes that we talked about over 2 weeks ago. On June 13th, the Feds raised interest rates. And as we've talked about in the past, there's a direct correlation with raising interest rates and how the stock market will react. We talked about if they raised interest rates, we'd most likely see the stock market take a downturn. Now, obviously, there's trade wars taking place between China and the United States. And as we talked about, this is a hen pecking order right now, seeing who's the biggest dog on campus between two of the world's largest economies. The Fed interest rate hikes is a crucial role in the U.S. stock market. People have to understand that the stock market is overvalued and it is overinflated. The Shiller Index will continue to confirm that, as well as the decline in the current Treasury bond yields. Treasury bond yields are continuing to decline. As they continue to decline, that means more Treasury bonds are more difficult to sell and you have more coming back from foreign countries. Since June 13th, which just a few weeks ago, we've only seen 3 positive days in the stock market. Now, we can say it's the trade wars all we want, but if we look at the statistics all the way across the board, if it's about trade wars and we're talking about steel and aluminum and a few items here, why are all the consumer goods down? Why are the retail stores down? The retail stores are where consumers buy goods. And when they buy goods, it supports the stock value, whether it be Apple computers, whether it be an iPhone, whether it be a Galaxy phone, whether it be Nike, whatever it may be. It doesn't matter. Long as the consumer is buying the goods, the stock value and the earnings of the company should be solid. But if interest rates is a key role in driving the stock price down, it confirms that the stock prices are overvalued. And this is something that we've been talking about for 6 months to almost a year now. We've continued to see the Shiller Index continue to rise, which is a confirmation of that happening. Right now, we're seeing U.S. Treasury bond yields continue to decline, which is further confirmation that the stock market is overvalued and the lack of confidence globally is starting to slack off in the U.S. economy. These are crucial items to understand when you have money sitting in the market. The U.S. stock market is at one of its most volatile and most critical points that we've seen in 10 to 15 years. Most consumers today have done well in the stock market, and we're not saying that you need to go run out and go pull all your money out of the stock market. As we continue to shoot these films like we're doing today, we're encouraging to look at the information as it is at face value. The consumers that we talk to and consumers that I talk to on a daily basis continue to talk about how they're in fear that the stock market is at a bubble. Most of them know that it's at a bubble, but the problem is they're waiting for a specific key indicator. They're waiting for a major correction and an extended period of time of corrections for them to pull their money out. Under this correction, folks, we are at a point where if the money starts declining, you will not be able to recover under this recession. The top experts across the entire United States and globally are telling us that the United States is headed for a deep-seated recession. And that nasty word that we've talked about before, some are even predicting a depression. And it's not just a few. I mean, Forbes magazine, Wall Street Journal, CNBC News, CNN, Fox News, all of them, their top analysts are saying that we could go from a recession and go into a depression. The Treasury Department in 2013 specifically listed key indicators. Those indicators were U.S. Treasury bonds. Those indicators were interest rates and a declining U.S. dollar. All 3 of those are starting to surface at the same time. Whether the Treasury Department will be accurate from a prediction that was done in 2013, I don't know. But all the things that we've talked about and all the items that we've listed out are all falling to become true today. So, with that being said, the new flyer that we have out today is a day without silver. Most of you know that silver is very undervalued, and most of you know that silver has been stagnant for over 1.5 years to 2 years now. Call the number on your screen to get more information with a day without silver so you can understand what's taking place and get more information about what we discussed today. And as always, thank you for watching USMR Market Insights and US Money Reserve.